Welcome back. There's another look at the U.S. markets. You can see the TSX Composite has flattened out, so stay tuned. We will see what happens with these markets as the trading day progresses. We are currently 4 markets into the trading day, and here in Canada into the trading week. Well, the U.S. elections, of course, are key to the markets this year. Most portfolio managers agree. Our next guest highlights how the markets could be affected and what investors should continue to watch very closely. We're joined by Brenda O'Connor Juanas, Senior Vice President and Financial Advisor at UBS. Brenda, thank you very much for joining us. We all knew that the U.S. election was likely to be an influential factor on markets this year. Then we had Joe Biden's performance in the debate. What is your take on how things stand right now?
Right. Well, thank you for having me on. Look, I am not exaggerating when I say that last Thursday's debate could not have gone any more disastrously for Biden. And I think that's the general consensus in mainstream media. Look, what he does in the coming days and in the coming weeks is to be seen. The reports from the weekend look like he's going to stay the course. My point here is that it is almost irrelevant because of the fact that we have an independent Fed. And I've been saying this for months, but the person that's going to make the markets move the most this year is not going to be Trump or Biden. It's in fact going to be Powell. Now, there are investors that are skittish. They want to make some tactical moves after last Thursday's performance. I mean, there's an opportunity here to, de-weight some election-sensitive sectors like renewable energy or consumer discretionary. But I think that Powell is going to be the main mover of markets for the remainder of the year.
It sounds like you don't see a big difference between markets under Trump or markets under Biden. And in fact, stock markets did well under Donald Trump and have done very well under Joe Biden as well.
Right. I think that for 2024, it's too early to tell. If we do get a red wave, so we need all 3 houses of government to be moving in a certain direction, then 2025 could be different. In that case, you can expect, lower levels of regulation under a Trump administration. So in that case, I would be overweighting sectors like financials, for example. But for the purposes of this year, this is still a situation where monetary policy is going to drive further activity in the markets, in addition to a really strong earnings story, and those are the things that investors should be focusing on.
What's your outlook on the upcoming U.S. earnings season? What kind of profit growth do you think we're going to see, and will it support multiples that we're now seeing in the U.S. stock market?
Right, Paul. So, we're at the first part of the second half of the year. So the first thing I would do here is just take stock about what happened in that first half of the year. There were some incredible milestones. The S&P crossed 5,000 for the first time. NVIDIA became the most valuable stock. There's also, of course, some very important monetary policy milestones, particularly in countries like Canada, Switzerland, the EU. In terms of what this means for markets, we're up 15% on the S&P year to date. I think, we're going to trade sideways for the next few months, these summer months here. But to your question, I do think these higher multiples, these higher valuations, particularly on U.S. equities, can be justified because of that strong earnings story underpinning it. We expect U.S. equities more broadly to be up 9 to 11% this year. But look at specific sectors like tech. We expect, up to 20% earnings growth for the balance of the year, 36% potentially in the second quarter. So there is still room for upside in certain sectors.
If I understand correctly, you think the very significant rally we've seen in the U.S. dollar has likely peaked, and down is more likely than up for the greenback from here. How might that play into the earnings story? It can be very, very material for the earnings performance of big U.S. multinationals that sell their goods and services abroad.
Right. I mean, the U.S. dollar has had an incredible year so far. We're almost at those annual yearly peaks up. The DXY, which is what we measure against the basket of 6 major currencies, is up 4%. Why? Of course, there's a lot of reasons why. We think that this is primarily a situation where the Fed has held rates for higher. It's also been a great safe haven trade. We have a very tumultuous geopolitical and election risk backdrop here. Maybe we see see a little bit of continued strength in the U.S. dollar in the short term. But Paul, the fact of the matter is, you look at U.S. growth, you look at some of the disinflation story that's happening. This is going to give the Fed enough ammunition to start reducing rates, maybe by 1 or 2 cuts. I know that's not incredibly meaningful, but it's that pivot that's going to be important, that's going to be priced into the U.S. dollar. So what I'm telling investors right now is to use a shorter term U.S. dollar rally to take profit, specifically against currencies like the yen and the euro.
Let's go to commodities. Gold is your preferred commodity. So I assume you see it moving off this 2,350 level where it's been lodged for a while now.
Right. I've been talking to the folks at BNN for a long time about gold. I was talking about it when it was under 2,000. I'm going to still talk about it at 23 and change. And I know it's been up over 20% in the last 1 year period. But Paul, the point is here is that gold, in our view, is the best commodity hedge to geopolitical risk, any concerns with U.S. deficit levels, any sort of storyline related to disinflation being stagnant. The other point I would highlight here is that central banks are buying the commodity to diversify their reserves. And so our view on gold is that it could be 2,600 by the end of the year, 2,700 by mid next year. And I think that's a great place to play, given that the fact we see markets are a little bit overextended now.
Okay, and why don't we finish with crude oil? Canadian investors always very cognizant of which direction crude oil is going in.
Yeah, so in terms of crude, again, we like commodities going into the next 12 months. Crude, we don't think there's as much of an upside, but we still think that the commodity could be closer to $90 by September. I view things as a basket of commodities for a lot of my clients. So, we think that basket of commodities could be up in the teens within 12 months. I would also, in addition to oil and gold, put in silver in there. We think our silver target of $38 looks pretty reasonable early in 2025.